Chapter 6, Working Capital and the Financial Decision. Chapter 6 Outline. What is working capital management? The nature of asset growth. Temporary current assets. Permanent current assets. Cash flow cycle. Financing alternatives, hedging. The financing decision. Risk-return trade-off. Interest rate volatility, summary, and conclusions. Learning objectives. Define. Define working capital management. Describe. Describe the effect asset growth has on working capital positions. Identify. Identify working capital management, considerations for permanent components, the effect of sales and production schedules, and liquidity versus risk. Identify. Identify the cash flow cycle of the firm. Learning objectives, Part 2. Explain. Explain financing of assets in terms of hedging. Describe. Describe the term structure of interest rates. Explain the theories that suggest its shape and identify how it may be of use to a financial manager. Examine. Examine risk and profitability in determining the financing plan for current assets. Working capital management. Controlling, managing, and financing the investment in the current assets of a firm. Most time-consuming job of a financial manager. Crucial to long-term success or failure of a business. The nature of asset growth. Sales or revenues are linked with production or costs. Receipts, cash inflows, are linked with payments, cash outflows. In the simplest case, all of the firm's current assets are self-liquidating assets, sold at the end of a specific time period. The nature of asset growth, Part 2. Sales and production are unlikely to be perfectly synchronized. Sales are supported by investment in current assets, often requiring permanent current assets. Sales growth increase the current asset investment. Internally generated funds often are not sufficient. Additional external financing may be required. Figure 6-1, the nature of asset growth. A. Stage 1, limited or no growth. B. Stage 2, growth. Controlling assets, matching sales and production. Two possible production alternatives in relation to sales. 1. Level production. Methods to smooth production schedules and uses labor and equipment efficiently at a lower cost but leads to fluctuation in current assets. 2. Matching sales and production, which eliminates the large seasonal bulges or sharp reduction in current assets. However, it is very difficult, if not impossible, to match sales and production perfectly. Most firms employ level production methods. It is critical to control the fluctuation in current assets. Figure 6-2. Sales and earnings for McGraw-Hill Ryerson over a 14-year period. Quarterly sales and quarterly earnings. Figure 6-3. Current assets at McGraw-Hill Ryerson over a 14-year period. Temporary assets under level production, an example. Yawakuzi Motorcycle Company employs the level production method to produce motorcycles while the sales of motorcycles is seasonal in Canada. Table 6-1, Sales Forecast in Units. Table 6-2, Production Schedule and Inventory. Beginning inventory plus production minus sales equals ending inventory. Table 6-3, Part 1, Sales Forecast, Cash Receipts and Payments, and Cash Budget in Millions. Table 6-3, Part 2, Sales Forecast, Cash Receipts and Payments, and Cash Budget in Millions. Table 6-3, Part 3, Sales Forecast, Cash Receipts and Payments, and Cash Budget in Millions. Table 6-3, Part 4, Sales Forecast, Cash Receipts and Payments, and Cash Budget in Millions. Table 6-4, Total Current Assets, First Year in Millions, Cash, Accounts Receivable, Inventory, and Total Current Assets. Table 6-5, Part 1, Cash Budget and Assets for Second Year with No Growth in Sales, in Millions. Table 6-5, Part 2, Cash Budget and Assets for Second Year with No Growth in Sales, in Millions. Table 6-5, Part 3, Cash Budget and Assets for Second Year with No Growth in Sales, in Millions. Figure 6-4, The Nature of Asset Growth. Cash flow cycle. A firm's ability to quickly convert assets into cash is referred to as liquidity. When a firm's liquidity is called into question, often it will be difficult to continue in business. Liquidity is largely determined by the cash flow cycle. Sales, receivables, and inventory form the basis for cash flow, but the firm's other activities can also affect cash inflows and outflows. Figure 6-5, the cash flow cycle. Customers, sales, accounts receivable, cash, inventory, sales, cash. Cash conversion cycle. Managers should pay close attention to the time it takes from the initial outlay of funds for raw materials until the firm collects funds from its clients for the finished product. This timing is referred to as the cash conversion cycle. Cash conversion cycle, Part 2. A firm's cash conversion cycle equals inventory holding period plus average collection period minus accounts payable period. If the cash conversion cycle is positive, then there is a cash gap that will require the firm to obtain financing. Figure 6-6, Cash Conversion Cycle Linear Representation. Inventory holding a period, average collection period, purchase, sale, cash received. Figure 6-7, Expanded Cash Flow Cycle, customers, sales, geographical area, product or division, customer type, accounts receivable, 0 to 30 days, 31 to 60 days, 61 to 90 days, or 91 to 120 days. Marketable securities, interest and dividends, short-term lenders, chartered banks, non-bank lenders, foreign banks and lenders, government taxes, federal income taxes, provincial taxes, other taxes, materials and service, suppliers, accounts payable, labor, wages payable, other expenses, inventory, finished goods, goods in process, raw material. Patterns of financing. The financial manager's selection of external sources of funds to finance current assets may be the firm's most important decisions. What if the firm has a smaller sales level? A large inventory needs to be financed and not generating enough cash. What if the firm finances with short-term sources of funds but is unable to renew the financing when they come due? Financing alternatives. 1. Hedging approach. Matching the maturities of assets and liabilities, the most desirable but almost impossible. 2. Conservative approach. Using long-term capital to finance capital assets, permanent current assets, and part of temporary current assets. Low risk but less profitable. 3. Risky approach. Using short-term funds to finance temporary current assets and part of permanent current assets, more profitable but risky. Figure 6-8, matching long-term and short-term needs, hedged. Figure 6-9, using long-term financing for part of short-term needs, conservative. Figure 6-10, using short-term financing for part of long-term needs, risky. The financing decision. A financial manager should balance short-term versus long-term financing by considering 1. The composition of the firm's assets. 2. The firm's willingness to accept risk. 3. The risks and potential payoffs from each financing alternative. 4. The term structure of interest rates. 5. The volatility of interest rates. Figure 6-11, decision tree and the financing decision. Short-term versus long-term financing. Short-term financing is less expensive but riskier. Lower interest rates usually. Short-term rates are volatile. Risk of default if sales slow down. Risk that banks may not extend or renew loans. Long-term financing is more expensive but less risky. Higher interest rates usually. You may pay interest on funds you don't always need. You have capital at all times. Term structure of interest rates. Often referred to as a yield curve for its geographical representation. Illustrates the relationship between yields, return, and time to maturity term at a specific time. A yield curve can be upward sloping, referred to as a normal yield curve, or flat or downward sloping, an inverted yield curve. Term structure of interest rates, part 2. 3 theories describe the shape of the yield curve. 1. The liquidity premium theory. 2. The segmentation theory. 3. The expectations hypothesis. The shape of the yield curve tells us important information about interest rates. Figure 6-12, yield curves showing term structure of interest rates. Figure 6-13, long and short-term interest rates. A decision process. The Edwards Corporation needs to finance $500,000 of working capital, current assets, and $100,000 of capital assets. It has identified 2 financing plans. Plan A, deemed risky, is to finance the $500,000 with short-term financing. Plan B, more conservative, is to finance only a small portion of the working capital with short-term money. Table 6-7, Alternative Financing Plans. Edwards Corporation, Plan A, Plan B. Part 1, Current Assets. Part 2, Capital Assets. Part 3, Total Financing. Table 6-8, Impact of Financing Plans on Earnings. Edwards Corporation, Plan A, earnings before interest and taxes, less interest expense, equals earnings before tax, less taxes, equals earnings after tax. Table 6-9, expected returns under different economic conditions. Edwards Corporation, normal conditions, expected higher return under Plan A versus Plan B, multiplied by the probability of normal conditions equals expected outcome. 2. Tight money, expected lower return under Plan A versus Plan B times probability of tight money equals expected outcome. Table 6-10, expected returns for higher risk firm. 1. Normal conditions, expected higher return under Plan A versus Plan B times probability of normal conditions equals expected outcome. 2. Tight money, expected lower return under Plan A versus Plan B times probability of tight money equals expected outcome. Shifts in asset structure. The manager faces a risk-return trade-off. On the asset side, as we proceed down the balance sheet, assets become less liquid. Longer-term assets carry greater risks but higher potential returns. Since the early 1960s, business firms have decreased the liquidity of their current assets. The increased cost of financing current assets may be one of the reasons for this decline. Figure 6-14, current ratio of non-financial corporations. Toward an optimal policy. There are 4 possible working capital alternatives based on the combination of financing patterns, short-term versus long-term, and asset liquidity. 1. The aggressive firm borrows short-term and maintains relatively low levels of liquidity. 2. The more moderate firm compensates for short-term financing with highly liquid assets. 3. The more moderate firm balances low liquidity with long-term financing. 4. The more conservative firm utilizes long-term financing and maintains a higher degree of liquidity. Toward an optimal policy, Part 2. Each alternative represents a trade-off between risk and return. An appropriate strategy is selected based on the company's tolerance for risk. Table 6-11, current asset liquidity and asset financing plan. Financing plan, short-term, low liquidity, 1 risky, high profit, high risk. High liquidity, 2, moderate profit, moderate risk. Long-term, asset liquidity, low liquidity, 3, moderate profit, moderate risk. High liquidity, 4, conservative, low profit, low risk. Summary and conclusions. Working capital management involves controlling and financing current assets. As sales increase, firm requires increased investment in current assets. Level production with seasonal sales and the cash gap in the cash flow cycle often require a firm to increase its investment in current assets, often with external financing. Summary and conclusions, Part 2. A hedged financing approach attempts to match the maturities of debt obligations to the maturities of assets to reduce risk. Unfortunately, the hedged approach is very difficult, if not impossible, to employ. A firm must tailor the various risk-return trade-offs to meet its own needs. Summary and conclusions, Part 3. The firm has many decisions to consider. Long-term financing may be safer, but more expensive. On the asset side, carrying liquid assets maintains the firm's availability to pay its suppliers but detracts from profit potential.